Hello, good afternoon and welcome to Mutual Fund Corner on CNBC-TV18. I'm Vini Murthiwala in the Mumbai studio. Today we'll start by discussing and focus on systematic investment plans. SIPs have emerged as a cornerstone of retail participation in the equity markets. The latest AMFI data has also shown a very interesting data point that equity fund inflows have jumped 15% to 41,156 crore rupees in the month of December. However, what would you do when you encounter negative returns in the current volatile market? What are the factors to analyze and what should you consider while actually seeing this negative return? Should you actually switch? What is the word coming in on this front? We'll discuss all of this with our expert for today. We have Tarun Birani, founder and CEO at TBNG Capital Advisors, joining in with us to talk to us about all of that. Tarun, thank you so much and good afternoon. Let's start by talking about this. Investors often start panicking when they see a negative return that comes in on their SIPs. How should they interpret such a phase that comes in the market? And I'm sure everyone faces this in the market once in a while. Given that it is the market, you will see ups and downs. What should the investor do at such a time?
Good afternoon, Vini, and thank you for having me on the show. I really love the topic today because I feel this is so relevant in the today's times where we are today. So let me just first give a quick background, and SIPs I think is like a cornerstone for Indian economy now, right? I think it has emerged like most of the retail participation of equity markets is coming through SIPs. And as we talk, there is almost like 26,000 crores of SIP on a monthly basis, which is going every month. And most of the FII outflow, which has happened in last 6 months to 1 year, I think most of the DIA money has come, the domestic investor money has come through SIP board. And this has really helped the equity flows in the market. So I would say SIP is an extremely important part of capital markets as we talk today. Now coming to your important question that what should investor do when their SIP turn negative? I feel we are trying to talk about the what should be the medicine. I think before that, most important part is we need to talk about the diagnosis. And according to me, the most important part is why do SIPs fail? Most of the time, SIPs fail because most of the investor do these investment because of the rear view, mirror view. They just look at current momentum strategies, momentum funds, past performance, and these are the strong big reasons to invest into market. SIPs have not been made to align with their long-term financial goals. These are done more to benefit from the current markets. So I think from an approach point of view, these are big reasons for SIPs failing. Again, over diversification of SIP schemes, investors end up taking 15, 20 schemes in their portfolio, which doesn't really help in creating wealth creation. So again, not aligning for long term, from a short term point of view, looking at SIP also has been one of the biggest reason why SIPs fail. And apart from that, thematic funds, right? Most of the times I have seen last 1 year, themes like defense, infra, all these have been like, because the past returns were very good, lot of fund flows have happened into these strategies, and SIPs also have been started in this. But if you look at returns, I think all these strategies have really given bad returns in last 1 year. Again, now I am coming to the solution part, right? What should be the medicine right now? One should take. I think investors need to look at SIP returns from a 5-year plus point of view. I feel 1 year, 2 year, 3 year returns are not a right benchmark, first of all, to look at the returns, because it could be because of the market cycles, and a market cycle takes almost like 3 to 5 years for a full cycle to complete. So looking at SIP returns just from 1, 2 year returns, I don't think is the right approach. Again, the SIP actually thrives on rupee cost averaging. And the whole benefit of rupee cost averaging happens when the market turns negative. So actually, these are the times, interesting time to actually increase your SIP, not to stop your SIPs. Yeah.
Okay. Increase your SIP, not to stop your SIP. Obviously, that's important coming in. But, any specific factors that investors should analyze before deciding in terms of continuing, stopping, or maybe even increasing your SIPs? What are these factors that one should watch out for during this downturn?
So I think the most important point one should look at while deciding to stop, continue, or increase their investment in SIP is first is their financial goals and timeline. I'm a strong believer these investments are not done to make short-term returns. These are wealth creation tools. The compounding magic comes if you really invest for a longer period, right? So the financial goals, I think that's the most important cornerstone one should look at to decide whether to stop or continue your SIP. If your investment objective is 5 to 10 years away, a temporary dip need not derail your SIPs. Equity investment actually required time to unlock the compounding benefit. Again, the second factor could be the fund performance vis-a-vis the benchmark. If you're consistently seeing over a 3, 5, 7 years, your fund is underperforming their benchmark. So let's say a Nifty 50 or a Nifty 500 stocks, you are continuously underperforming. I think it is time for you to actually reevaluate whether to continue that strategy or not. Again, another reason could be to stop your SIP, could be your risk tolerance and life stage. Young investor with a longer horizon can ride out a market cycle much more comfortably. Those nearing retirement or with liquidity needs might be more cautious. So again, this can make you decide whether to continue or stop. And again, your financial stability, if you have emergency reserves and stable income, consider leveraging the downturn to increase your SIP allocation, actually. But buying low forms the backbone of the wealth accumulation in your portfolio.
Okay. Tarun, what I want to also understand is historically how long-term SIP investors have benefited despite the short-term negative returns. If you could give that analysis or some example on that front as well, help viewers understand that they should not panic at such a time and maybe not just step out of their SIPs or just stop their SIPs. Could you give us an example there?
Yeah, so I think the most important and a simple example could be, let's say, if you are doing a 10,000 rupees monthly SIP and you are at let's say, 85,000 Sensex level, your NAV could be 12 rupees at that time. So the number of units you are buying is much lower compared to the units you would be buying at, let's say, 75,000 index level. So if the NAV turns to 10 rupees, I think you would be actually buying much more units. So actually the rupee cost averaging starts happening over a long period of time when you see a full scale cycle of 5, 7, 10 years. And that is where the actual benefit of SIP really comes into play. And the most important part is the compounding. If your money is growing at 12%, every 6 years, you are doubling your money. And if your money is growing at 15%, you are doubling your money in every 5.5 years, right? So again, these compounding benefit actually can happen only through SIP mode, because when you invest over a lump sum period, you are actually every time thinking whether the markets are good, bad, or ugly, right? But when you are doing a SIP mode, you are actually buying on a regular phase, right? So that really helps you to compound in that period. Again, we have done some studies wherein, say, 10 years back, if you would have invested as a lump sum versus invested through SIP mode, and you have seen a lot of market cycles like Brexit, COVID, all these geopolitical tension, Fed rate hikes, everything. I have seen in the lump sum thing, investors would tend to pull out their money much faster. But if you've done the money through SIP mode, you tend to retain your money. There has been a study done of investor return versus investment return. And we have seen almost like 3-4% return difference because investment has not been kept for a longer time. And due to that their investment returns have been compromised. So I feel over a long period of time, the compounding magic is the large reason of that SIP giving you better returns.
Absolutely. The compounding magic always works. And I think everyone always suggests that compounding magic. So just do wait on and be patient, I think. That's an important cue that comes in and you have to understand on that front. Tarun, on this topic, what I also want to know, are there any tactical steps, I beg your pardon, that a viewer should take, something like a top-up SIP, especially during these market corrections, that would benefit them in the long run or improve their returns in the long run?
Absolutely. I think during these market corrections, consider a lot of tactical approaches, like one can do top up or step up SIP. You can increase your monthly contribution, which can harness the lower unit prices. Again, it is potentially boosting your returns in the recovery phases, right? Again, lump sum investment. You can plan some lump sum investment to ensure your rupee cost averaging benefit become much stronger in your portfolio. And in these market dips, so say 20, 30%, 25% fall actually warrants some bit of lump sum investment to come in. And apart from that, rebalancing your portfolio. If you have defined your target allocation of a portfolio, let's say 70-30, 70 equity and 30 debt, and due to market fall, you are observing that has gone to 60%. It is actually a great time to actually pull up your target allocation back to 70% and increase your equity investment by 10% in the portfolio. So I think these are some of the ways through which investors can benefit from these corrections in the market.
Okay, these are some of the ways that maybe you can benefit from the market. So do not just get out of the SIP. Wait and look at the long-term returns, right, Tarun? If I'm summing it up right, wait and look out for long-term returns. And there are steps you can improve your returns, step up SIP, lump sum SIP, and other methods that even Tarun mentioned.
I feel the most important part is before you start, have a purpose when you start SIP. You need to have a very clear purpose when you are investing and doing investment. I have seen 50 to 70% of the time it is random investing. And due to this, most of these SIPs fail.
Absolutely. So have a purpose also for your SIP, have a goal. That's the word also coming in from Tarun. But on that note, we're going to step into a very short break. But on the other side of the break, we're going to be discussing an exciting topic where SEBI's initiative to lower SIP threshold to 250 rupees with Tarun himself. So don't go anywhere. We'll be back. Welcome back and thanks for staying tuned into Mutual Fund Corner on CNBC-TV18. We still have our expert with us, Tarun Birani. And now we're going to shift focus and talk about SEBI's initiative to lower the SIP threshold to rupees 250, which I think is a very essential stride towards democratizing investments. Now, what does this mean for investors? What does this mean for the industry as well? We'll talk about all of that. Tarun, it's a very interesting move that has come in. Now, how do you think this reducing the amount to 250 rupees as a minimum investment will impact retail participation? Do you see more investors coming in the industry? And overall, how do you see this move?
Absolutely. So I feel on the regulatory front, SEBI initiative to lower the SIP threshold to 250, according to me, is an essential step towards democratizing investment. And again, this aims to bridge the financial gap between the high-income urban segment versus the first-time investors in the smaller towns as well as in urban towns, right? So again, it will really help in deepening the financial inclusion across India. So I feel this push for micro SIP directly supports India's broader growth narrative, which actually hinges on the expanding participation beyond large metro. I feel India has a very, not a great social security system, unlike the developed markets, though we have NPS and all these catching up. But I think most of the Indians don't have a social security in terms of retirement corpus and all these benefits. I feel with the capital markets doing so well and given this stride towards putting smaller amounts in investment, I feel every strata of society can actually participate in the Indian growth story. And that can really help investors to create a long-term social security for themselves. So I feel it's a great move in a country where the social security is not that great and retirement benefits and all these things are not available to the tune it should be.
Right. Tarun, will this move primarily benefit first-time investors or encourage existing investors to increase their participation? What is your thought on that?
So I feel actually it's advantages to most advantages to the first time investor who are unsure about locking in large amount monthly. They can test the waters with actually a smaller amount and can see how it works, and based on that they can plan the investment. For existing investors also, it opens up in terms of investing avenue. I think they can start doing some additional SIPs into with a smaller amount. So I think yes, both the first time and existing will benefit from this.
Okay, and your thoughts, especially coming in terms of the penetration we could see for mutual fund industry in smaller town and rural areas. Do you think this will, something increase the penetration there and more participation would come in from that front?
So actually, if you ask me, it's actually start to happening with the wealth creation happening in the equity markets. We have observed many tier 2, tier 3 and towns are also participation with good mutual fund flows coming from there. But I feel with this move, it will actually deepen the penetration beyond the metros. And people in tier 2, tier 3 and rural segment can actually start building portfolios even with a modest monthly investment. Again, with the digital accessibility available, I think we have so many such great platforms available, often with eKYC and UPI option. It makes it simpler for remote investor to set up SIPs. And again, it will shift from the traditional saving habit. So if you ask me, the asset classes where most of the Indians invest is gold and real estate, which are physical in nature, right? Again, this shift can really bring in a lot of financialization and a lot of benefit to the economy and growth of this country. So I think it will really help in penetration.
Okay. It will help in penetration, especially in the smaller towns and rural areas also. And thoughts in terms of boost for financial inclusion, or do you think it's more likely to be just a psychological nudge for these investors, given that it's such a small amount that you could invest? What do you think these factors are going to play?
I think it's actually both, right? By design the lowering of SIP amount broadens the investor base, an explicit step toward financial inclusion. Yet the psychological shift is equally significant because many potential investors perceive mutual fund as high risk, requiring large sum. So with a smaller amount, it's a great nudge for anyone to see, experience how it works, and accordingly they can increase or reduce that same.
Okay, and how do you think investors should actually think about starting this 250 rupees SIP in terms of wealth creation and the potential that is there, in this SIP? What is it that one should watch out for?
I feel it should be used as a wealth creation tool and building a saving habit, right? Culturally, I think we Indians are great in saving. It's just that the saving is not going in the right places. So if it starts going down from the lowest level also, I think it will really bring in a lot of prosperity in this country. So I think building a saving habit, again, it has a lot of room to grow as the income rises or the comfort with market volatility improves. You can easily step up your SIP contribution. And again, the large part is compounding, right? As you will start observing the compounding benefit, I can see most of these smaller investors will turn into large investor in times to come. So I think it's great from that point of view.
Okay, maybe start small and then become big investors. But, what would you advise? Right now we were talking about previously also as an option is step up investments and step up SIP. Even though it's such a small amount, would it make sense maybe to go in for step up SIP? Does that make comprehend to the factor that it's such a small amount?
Yeah, I think step up SIP is nothing but at times when you see the market levels are correcting, and at that time you can actually buy more units. I think it's a great strategy to increase your investment, right? So I think a step up is actually benefit from that.
Okay, and your thoughts, this is coming right now, but should a viewer start this sort of an SIP, even if it's a small amount right now? Is this the right time to begin this?
Yeah, I think for investors who have not experienced mutual funds, for them, I think it's a great thing. And now is the right time. I don't think one need to time the things. I think one should actually define a purpose and a goal and accordingly start investing. So now is a great time and look at things with a 5 to 10 year point of view. And I think compounding benefits start coming in.
Okay, so you look at it with a 5 to 10 year view, it's a good move that's come in from the regulator itself as well, especially to support in terms of financial inclusion, increase it towards the participation, meaning coming in from smaller town cities, and people who do not have a large amount also can start this and benefit from the compounding interest. Am I summing it up right now, Tarun?
Correct. You are absolutely right.
Absolutely. So, just one thing that, when this move comes in, do you think for an industry perspective, is there something that one should be watching out for? Like from the mutual fund industry perspective, how is the costing going to be from the industry side I'm talking about?
I think definitely to increase the penetration with such lower SIPs and all that, I'm sure the incentivization and all that need to be done at a larger scale. So definitely in the start, it will involve the expenses and all that will be higher. But once it start trickling down and with the kind of digital platforms available, I think it should be taken care of. So I don't see this becoming as a very large expense item for them. But it has a huge implication in terms of building a sustainable flow for the markets. So as a DII, I think domestic investors will continue to participate and you will see this will bring in a lot of positivity, even in terms of whenever global geopolitical actions happen, at that time, the country can continue to perform well, right? So it's a great move.
Okay. Tarun, thank you so much for joining in with us today and explaining us both in terms of the SIP, which will be starting as low as 250 rupees, a new regulation coming in from the SEBI, as well as in terms of what should one do when SIP returns are negative. Thank you so much for joining in with us on the show today.
Thank you.
But with that, we're absolutely out of time in this edition of Mutual Fund Corner on CNBC-TV18. Thank you so much for tuning in. Up next, you have Closing Bell to take you through the next hour of trade.